Ken Griffin and Bill Ackman are considered to be apex predators of modern finance. But to generate their historical averages of 16 to 19% per year, they employ armies of PhDs and take massive risks on overpriced tech stocks just to beat the market. It takes the average Wall Street fund over a decade to double your money. During yesterday's trading session, Fiserv flash crashed. Fiserv is an S&P 500 financial monopoly that processes 35% of all U.S. merchant payment volume. Yesterday, the stock dropped 11%, closing at a multi-year low of exactly $47.91. The reason: the CEO, Mike Lyons, abruptly resigned. Wall Street threw a blind emotional tantrum over an executive departure. Trading bots dumped the stock, completely ignoring the fact that Fiserv's underlying cash flow remains entirely intact. Today's drop to $47.91 is a once-in-a-generation dislocation and one of the best opportunities I have seen since the 2020 crash. Here is the exact SEC math on why I am assigning a 98% probability to a 125% return in the next 25 months. To assign a 98% probability to any investment, you have to mathematically eliminate the downside. At today's closing price of $47.91, Fiserv's market cap is $25.5 billion. If you read their official 160-page SEC Investor Day filing, they generated exactly $4.43 billion in free cash flow last year. Generating $4.4 billion in pure free cash flow on $25.5 billion valuation is a staggering 17.3% free cash flow yield. What is the company doing with this cash? The management is legally guiding to over $13.5 billion in free cash flow through 2029 with the explicit mandate to buy back their own stock. Because the price crashed to $47.91 today, the company gets to weaponize the cash to retire their own shares at rock bottom multiples. The downside is entirely blocked by a corporate buyer with a $13.5 billion wallet. In 2029, the company is forecasting an adjusted EPS of $12 a share. At $47.91, we're buying an entrenched financial monopoly at an impossible 3.99 multiple on those 2029 projected earnings. When the market stops panicking over the CEO and simply grants Fiserv a deeply conservative, below average 9 PE multiple on its $12 earnings, the stock re-rates to $108 by 2029. From today's $47 close to $108 is exactly a 125% gain. When a cash premium monopoly drops to 13% yield, elite operators hold the line. This looks to be an unlevered return that crushes hedge funds with vastly less risk than they are taking.